Good morning, everyone. Thanks for coming along to listen to us talk about endowments. We might be here all day because Jamie wanted us to cover the world. Current investing climate, asset allocation, portfolio construction, valuation, liquidity, and the implications for the manager selection process. So by the time we get through that, it'll be 6 p.m. Let me introduce the panel. Mike on the far side here and I are partners at Global Endowment Management, from which I retired last year. Global Endowment manages the assets of about 40 endowments and foundations, in excess of $10 billion out of its base in Charlotte, North Carolina. Eric Eupen, to my left here, was the CIO of Stanford University's endowment, and McKenna Capital Management, another OCIO, like Global Endowment, an outsourced chief investment office. He's on the board of WashU, and has been CIO pro tem there as well, so that's 3 times a CIO. He's also a board member of the Patrick J. McGovern Foundation. And then Matt in the middle, Matt Hohen is the co-head of custom asset allocation at TIF. TIF is one of the earliest multi-client endowment managers in the country, so it has a very rich heritage of endowment management. And he spent 14 years for his sins at GSAM, Goldman Sachs Asset Management, if I've got that right, and 4 in BlackRock's endowment and foundation effort. So we've got a fair amount of endowment management experience on the podium today. I've always loved the expression, "In God we trust, everyone else can bring data." So let me set the context for endowment management a little with some data. US E&Fs manage $2 trillion. The endowment part of that E&F it manages about $800 billion. That's $100 billion more than the government of Singapore, I found out this morning. The top 25 endowments manage $450 billion, so north of 50% of the entire assets managed by endowments in the US are managed by that top 25. It's worth paying attention to the largest endowments and what they're doing. Why do we care about endowments generally? Well, they're important to their institutions. Stanford provides about 1/5 of the operating budget for the university, Stanford's endowment, each year. Yale's 1/3. They're important to venture capital, which is what we're here for largely. 50% of some of the large endowment allocations are to illiquid strategies, and a fair chunk of those, think 20, 30, 40% to venture capital. So what they do in venture matters. They're important to learn from. You know, the bellwether at Yale, or being Yale, has beaten US stocks by a couple of points a year for 20 years, ended June 30 last year with a lower risk portfolio. So that's pretty good performance, whatever way you cut it, across any type of institutional asset management. A word from our sponsors today, Athletic Greens, AG1, wrong sponsorship, sorry, that's from a podcast. Oldwell Labs, if we can bring up the slide please. Oldwell Labs has the most comprehensive data on money managers globally that we've come across. They put together this slide for us. Campbell Wilson's in the audience here if you'd like to speak to him about his product, which is a very data-driven product. This slide is the top 10 performers over the last 10 years. That's the period for which we can get the best data for endowments in the US. So the top 10 performers, and it throws up a few things. Firstly, only 2 schools have outperformed US stocks over the last 10 years. That's Bowdoin and MIT, and they've only done it by a small amount. All of this top 10 have outperformed a 70-30 mix of passive stocks and bonds. So that's probably a better proxy for the amount of risk endowments are taking in their portfolio construction. So that's good on the top 10 side. Not shown on this slide is the median endowment, which has underperformed US stocks by about 4% a year for 10 years. And most importantly, probably also not on the slide, but if you know the people involved, 4 of these top 10 schools, and by my math that's about 40%, right guys, are led by Yale staffers or Yale Investment Office alum. People matter in the endowment management business, it seems. So with that background, I'll turn over to the panel for a few questions. And just to start with each of you, I think it'd be helpful to understand what you think the endowment model is in 2023, where we stand today, and how has it changed over the last decade?
Please.
There you go.
Having been cold called, okay, endowment model first. Endowments are very unique portfolios because they're one of the few that are designed to never be spent. If successful, you are not touching the corpus. You are trying to create a payout of 5%, and you're trying to also provide the purchasing power protection or the inflation. So you're really trying to get 5% payout plus inflation, which for universities has been running at about 4%. And if you can, you're trying to get 1% to 2% more, 10 to 11% returns, which is utterly and truly profound if you can do that for a university. So one portfolio is not designed to be spent. Almost every other portfolio is ultimately going to be given to someone else, confiscated by the taxing authorities, or spent over a lifetime or over a child or other descendant's lifetime. And because it is a permanent horizon or perpetual horizon, you really can use time horizon as a competitive advantage. So the second distinguishing view, in my opinion, is a heavy allocation alternatives, doing everything you can to use time horizon as a competitive advantage, to be really focused on, as Hugh pointed out on this slide, the 10-year numbers, the 20-year numbers. And when you start to see compounding, which is just simple math, over 20 and 30 years, and most of us in this room are going to live 20 to 30 years. Forget about a university horizon of several hundred years. Harvard is older than the United States. That compounding, even at 1% a year, is stunning in terms of what's occurred, and that's what the Yales, the Princetons, the Harvards have done so well. So secondly, very heavy allocation to alternatives. Third, it's a very efficient model in that you are an asset allocator and you're a manager selector. So rather than doing a lot of direct investing, you're finding the very best in their local fields and putting together a portfolio of the very best that specialize in private equity, venture capital, and particularly in those alternative areas. And the last thing I'd say that's distinguishing is that in the alternative private asset classes, as viewed in the endowment world, the dispersion between good and great is huge in the private asset classes, meaning in venture, almost all the returns are achieved in the top quartile. And owning the median of venture capital returns, just throwing a dart at a bunch of managers, will probably, and has consistently, underperformed NASDAQ. So this selection ability, portfolio construction, building portfolios of managers, where if you are able to pick the most talented and the most effective at executing, you can produce additional returns at the same unit of risk versus taking more risk to produce those returns. How the endowment models changed, I think the two big changes. The portfolios are bigger. The institutions are more dependent on them. When I was at the Stanford Endowment many presidential administrations ago, the university wasn't as dependent on the payout. And therefore, there was a lot more latitude to invest with a longer horizon and to tolerate more volatility, which is a risk you could argue a long-term portfolio doesn't really need to pay attention to. You can measure it. But if anything, you should take advantage of that risk. And as you start to become more dependent on the portfolio, you pick up more characteristics of a pension portfolio. If you have high dependency and a little ability to move around if the portfolio is spinning out less, meaning you could start to eat into the corpus, especially if we have several tough years, which we did in the 60s and 70s, where we had 16 years secular bear market. The Dow broke 1,000 in 1966. It closed at 777 in 1982. That's what happens when you have high inflation volatility, interest rate volatility. And inflation didn't even peak until the late 70s. And the second big problem for endowments is they've gotten big. So when you're a $16 billion endowment and you want to write a 2% position in a portfolio to a manager who's going to own 10 or 20 stocks, really hard to write a $320 million check to a manager that can really perform, because you're looking for these smaller funds that have the ability to really move the needle. So there's been, I'll pass it to these guys, but there've been a lot of changes as to how to manage these bigger portfolios to perform when you can't just own 4,000 individual securities across 300 managers and think you're going to be on this board.
Yeah, I have a couple thoughts. I mean, the first thing that jumps out at me is it's pretty remarkable. I mean, the term endowment model has been with us for quite a while now, but it's such an amorphous term. I mean, it means such different things to different people in different contexts. I mean, people can use the word endowment model, and they can mean a highly liquid portfolio, or they can mean exclusively active management, or they can mean a perpetual time horizon, et cetera, et cetera. And so I've always found that to be one notable element, is that people can use the term and mean different things. In terms of where the quote endowment model is going and what are some of the secular trends that would potentially be helpful to this group, two jump out at me. One, to some extent, is the people on this stage. I think increasingly, as endowments and foundations are managed by outsourced chief investment officers, you will see a better collection of practices at these committees and on these portfolios. The OCIO, or outsourced chief investment officer, industry has grown massively over the last decade, and as that continues to happen, I suspect you'll see just better managed portfolios. And then the other element I wanted to raise to kind of amplify Eric's point a bit is on the private market side. We've done research internally at TIFF that shows basically a nearly linear relationship between the percentage of private market allocation that an endowment portfolio has and its excess return. Just very, very simply, the more you have in private markets, the better you do over the long term. And I think so the private market industry is clearly growing outside of endowments and foundations with sovereign wealth funds and banks, insurance companies, pensions, et cetera, not to mention high net worth. But I think it will continue to grow in endowments and foundations also, because the evidence is just so clear that more private markets equals more returns, equals a better ability to support your mission.
That's interesting, because you each said sort of slightly different things when it came to private assets. And when Eric said what he said about media and venture, I almost stood up and cheered. We get this a lot because we measure private equity a couple different ways. And one of them involves against a public benchmark, which I get a lot of pushback on. The other is universe, because you want to be able to demonstrate you're better than the average bear at picking private equity. But if it doesn't beat the public markets, ultimately, what's the point? And the truth is, it's been a very tough benchmark. The pushback, of course, is, well, certainly there's no liquidity premium for investing in privately. There's not. You deserve one. Investors deserve one. Endowments deserve one. But to Eric's point, and I love that he said dart throwing. Exactly right. Dart throwing means a premia is accessible by just sort of randomly accumulating things. So if you believe in a small cap premium, you can just invest in a very broad basket of small cap stocks, and you really can't do that, with say venture capital. Certainly, I'm sure your data is true or is correct. Although there have been some periods, certainly, where the S&P outperformed, sure, where the smaller endowments, we called it the smile, the Nakubo smile, right? So the very big ones that Hugh is talking about did fantastic with some of the best venture capitalists in the world. The people in the middle that don't have that kind of access did not do so well, and the smaller ones who have to be mostly passive were doing great because things were passive. I think the last thing I would bridge in what was said about endowment model, because I've had the same frustration, and I think it's probably Swenson's fault, because Pioneering Portfolio Management, late 90s, seminal book, Bible for our industry, but I think a lot of people read that as a cookbook, and it's not, right? It's not it doesn't give you a list of ingredients and sort of how to put them together to create an endowment. What endowments have done forever really is it's a model of innovation. And you can see this if you go back and look at endowments, to King's College, but the one I always have in mind is the Chicago Endowment. In the 40s, they were investing in mortgages for golf courses. That was an alternative investment at the time. And so it's always been just sort of pushing into less efficient areas, and that's probably the thing that best characterizes what we mean with endowment model.
And if I could just add one last point, just to tie some of what we've been saying together. The endowment portfolios are almost obviously unique in that they're a single portfolio. So when we come to working on an endowment portfolio, the simplicity of a single portfolio is a beautiful thing. Because the minute you have to have 10 or 20 portfolios and figure out which client should get how much of this unique privileged access that if you work at a university, you get lots of special ability to get relationships, access, and capacity. The beauty of coming to work every day when you have an endowment with 50,000 gifts sponsoring thousands of scholarships, hundreds of professorships, and hundreds of research projects, and you come to work every day, one portfolio, your job's to beat Yale, is a beautiful construction. Almost no one else has it, because in a family, you have the foundation portfolio, you have the irrevocable trust portfolio, the generation skipping trust portfolio, the Wyoming portfolio, the Delaware portfolio. Families that have enough capital to run an endowment portfolio easily have 20 different portfolios. So you spend more time figuring out solving the Rubik's Cube of where it comes. And so endowments are beautiful in that they're a single portfolio and they're designed to travel through time. There's no death. There's no birth, there's no divorce, so it is a singular entity serving a singular entity, and not having tax, death, and proliferation or increasing birds in the nest allows you to focus supremely on that portfolio. And lastly, which is often lesser known, and we can certainly talk about this chart and how to look at it, interpret it, but endowments are about performing. Your performance is public. Most families, in my experience, have no idea how their portfolio is performed, none. And they have even less idea what benchmark they would use to answer the question, is the portfolio performing adequately? Or thirdly, since you're taxable, and if you live here in California, where we have wonderfully a 14% top tier state tax rate for all the great services, education, and safety the state provides, you're after tax return.
I got it. Politics, sex, and religion.
Sorry,
Okay.
but the tax component, whereas in the endowment world, maybe to a fault, compensation is highly tiered towards performance. And so peer comparison, which a purist would not like, is a big part of this model in that your results are public. The institutions are highly dependent on you. You're competing against your peers, and you will be removed if you're not in the league of the top players. If there is an alternative to you, is a different ethos that also drives this model, at least my view.
Duke versus UNC on the basketball court's got nothing on endowment management.
Well, to a fault, an interesting way to phrase it, right? Because originally, Yale versus Harvard, for example, that mattered because they were competing for the same professors and the same students, and it's turned into more of a performance game for the sake of it, which I agree that to a fault is the right way to think about it.
We should talk about interest rates. 30-year.
Too damn high.
What's the impact of the interest rate environment on what everyone on this chart is going to be doing with their portfolios this year and next, and how does it have you thinking about portfolio construction, where you're investing? Start with Mike.
Go.
You've got an opinion. I know.
Well, there's a hurdle rate now, and I think I could say way too much about this, but again, given the people in the room, here's what I would limit it to, because I do think it's an important question. You know, the thing about technology folks is they're usually busy making the future. They don't have to worry about the future. As a macro guy, this is sort of selfish to say, but you know, we go through these waves where you kind of have to care about macro. That's happened around the GFC and a little bit after, and I think for some of you, you have to care too, because there's two pretty distinct views of the world. I would say one is what's priced in markets today, which David Kelly from JP Morgan Asset Management finally said out loud on Bloomberg recently, which was, yeah, it's been a roller coaster, but the thing about roller coasters is you get off where you get on, and when this is over, we'll be right back at 2019. I do not believe it. That is one view, and that's very good for you in technology, because if that's true, we go back to a world where lowflation is the dominant concern for central banks, where there's not really interest rates, where you don't really have to discount the future to come up with valuations, and that's a very good environment, particularly for tech-focused investors. However, if you think that the anomaly preceded the pandemic, that we had 3 decades of tailwinds from globalization, from the fall of the Berlin Wall, from labor force increasing by 200 million people, from the technological revolution, thank you, and then that was met with a deflationary spiral in the GFC that further exacerbated that and really created that as a dominant risk. And you think that that's over, that normalization actually means going a little further back to where inflation's a bit stickier and it's higher and there's not this persistent disinflationary trend and that you live with interest rates. That's a very different environment. You might have guessed that's the one I believe in. And it also raises the bar for endowments. A lot of endowments, and this started really last year, a lot of endowments are talking about things like performing credit, where you can get 6%. Absolute return is the thing again. So we went in hedge fund land for a long time. We didn't have any of that. And my explanation after the global financial crisis was it's all levered carry. And after that, there was no leverage and there was no carry. Well, now carry is back again. So that's another competition for capital. So I think it just, it's going to raise the bar, and it gives endowments maybe a bit more options. There are alternatives now, is the real conclusion, I think.
Yeah, it's really interesting. I tend to align pretty closely with Mike in terms of, I think it's unlikely that we'll revert to a post-GFC landscape where we have low rates, low inflation, incredibly low macroeconomic volatility. But that said, I do think that some of the secular forces that did bring about some of the virtuous trends in inflation are still with us. Technology, and even though I do think that globalization is slowing, I think that is still a force that will come into play. In terms of managing endowment portfolios, I think there's a few elements that are noteworthy with respect to the rate environment. The endowment and foundation community, generally speaking, has not invested significantly in fixed income. And it is interesting. If you look at the 90s and the 2000s and the 2010s, you had this beautiful relationship between equities and US government bonds where they were negatively correlated. And famously, Bridgewater and many other asset managers put together these risk parity portfolios where you would lever up the government bond part of the portfolio and create this really kind of tidy strategy where anytime there's a slowdown in growth, stocks were getting beaten up, your levered government bonds did quite well. That is one of the really interesting elements to me for the coming years. If central banks can keep a reasonably close control on inflation, even if we have a higher, quote, R-star equilibrium interest rate in the economy, if inflation is under control, there is real reasons for optimism that you would see that negative correlation between stocks and bonds. And so there could return. And so there could be an opportunity in a higher rate environment to not only get that correlation impact, but then also just collect the carry. So I think that's one element that's pretty interesting. And then, of course, hedge funds for a decade plus, didn't have anything to invest their short rebate in. And so all of a sudden, the absolute return of hedge funds, the Sharpe ratio of hedge funds, is going to get a little bit more interesting. So I think those are some of the big elements for endowment and foundation portfolios in this new rate world.
And for me, just building on those great comments, one, interest rates are the price of money, and that's a really big deal, like a really big deal. And when you buy a house, you're not looking in a price range. You go to a real estate agent, and they ask you, how much can you afford a month? And that drives the price of your house. And purchase of almost any major capital equipment is all done on debt. And when you look at our economy over the last 20 years, being an old guy, having grown up in the 60s and 70s and remembering the high inflation period, and it doesn't go away quickly. It goes away with severe medicine. And it took almost 16 years for the US to do it last time. Different economy today, but it's the data we have, and it's more instructive than the it'll work out okay approach that I see most take. In interest rates are at a level that a huge number of businesses and professionals today have never ever seen in their lifetime. And what I tend to see with young people, having been one a long time ago myself, if you haven't seen it yourself, you're not going to listen to some old guy. You got to see it for yourself before you really believe it. And one of the first things when I was on Wall Street I was taught is you don't fight the Fed. I mean, the market has been fighting the Fed for the last 12 months. And so on interest rates and how to think about them, I throw out these points. One, we're not even 12 months into the interest rate cycle yet. The first interest rates were done in last March, late March. And out of the big canyon of the Fed came a little green pea of 25 basis point increase. We haven't been in the blast phase of major rate increases for more than 6 or 8 months on average, and it takes 1 to 2 years. No one knows how it's transmitted and how long it takes, but it will be a big deal for anyone that has variable rate mortgages that come unlocked, for companies that have to reissue debt at a completely different level. Even for the US government, the rate we're going to be paying $1 trillion a year in interest expense. We are already borrowing money to pay the interest on the debt because it has spiked up, and most of the US debt is around 3 to 4 years, not 30. We didn't refinance a lot of it, foolishly in my opinion, when we had 1% rates on the 30-year bond. And so this interest rate sensitivity is very powerful, and we've only just begun. Number two, one of the most important measures when you ask, is the Fed neutral or not, is what is the overnight Fed funds rate, the truly only thing they can completely control. They can affect the yield curve by going out and buying or selling securities. But today, after almost 12 months, we have a 4.75 overnight Fed funds rate, and the inflation rate is 6.5. And the most recent readings, and we're getting a big reading on Friday with the jobs number, the most recent readings, the PPI, the Producer Price Index, which is a leading indicator of what businesses charge the businesses, and that gets worked through, came in at an 8.4% reading. But if we just go with 6.5, we have almost a 200 basis point negative real yield. So we are still hugely accommodative. And when you look at the US government spending $1 to $2 trillion more a year than it takes in on a $24-25 trillion economy, we're still accommodating. And it is a big adjustment process. Number three, these things take years to unfold. And in our modern day of instant gratification, very painful to be sitting at an intersection and watching traffic go by for 4 years and trying to get some insight from that. And that is what these interest rate cycles are. Unless this thing quickly returns, because it was complete supply chain disruption and maybe arguably over-infusion, staying away from politics, of fiscal policy and working to try to keep the country stable through a very scary pandemic, then these cycles tend to last a long time. And the reason we have high interest rates is because that's about the only medicine there is to slow down a runaway economy. And what is occurring is that we are now very comfortable and nonchalant when people raise money. That's the beginning of what's called price spirals, demand price spirals and wage price spirals. When it's getting more and more expensive, and then you go to your employer and demand higher wages, and then you're spending more through the economy. Sadly, to slow this down means a few million people need to lose their job, and several 100,000 businesses need to declare bankruptcy, is what is required in applying the brakes. So either inflation is going to have to come down from its current 6.5 level and then meet where the Fed is today, or the Fed is going to have to go to inflation or above. And because I lived through it, and I do think it's instructive, recognizing that the US is not the same economy, the global economy is not the same. When this all occurred, you couldn't even go to Russia, let alone anywhere in the interior of Russia. The US in the early 60s had the Cold War, the Vietnam War, the war on society, the launch of Medicare, and the launch of welfare. And For many years, when I was first being taught economics, the view was we solved the business problem, much like you heard over the last few years. No matter what we do, we can't move the inflation needle. We must have built an economy so beautifully efficient that we burn all of the gas and emit no exhaust. And then all of a sudden the inflation started showing up because it takes a while for it to build. And it started showing up in the late 60s. It did not peak until the late 70s. It was the late 70s that inflation, after hovering in the 6, 7, and 8 range, popped into the 10 to 12 range. And it required a level of medicine that is unclear if the US could even politically do today. But it killed inflation for the next 40 years. You had a disinflationary cycle that was one of the most beautiful times to be alive if you're in the equity world. And so today, what you have in terms of what's your investment strategy is the alternative, as Mike pointed out, is very attractive because when you have high interest rates, you tend to have lower equity rates of return. And that is potentially going to be lower returns in some of the traditional asset classes. And either you need to prepare for lower returns or look for other sources of returns during a much more difficult environment. There will be great opportunities. A couple opportunities. One is in venture, because although you can't time venture, venture is human innovation, venture is disruption, and it is independent of what occurs in the economy. The companies like Microsoft, Intel, Apple were all created during the most excruciating part of the late 70s. Often tough economic periods create more startups because you're out of your job or you don't see a lot of upward mobility and you start your own thing. So venture is one very interesting area, but anything that's interest rate sensitive is either going to have more pressure or produce lower returns. So another area we're looking at is distressed debt. There's not a lot of it right now. We did get Bed Bath & Beyond, but we're just at the beginning of seeing if interest rates get so high, they're going to crowd out the ability to produce profits or even pay all your bills. That's what happens in an interest rate increase cycle. And through that will be opportunities to find some real interesting low-priced things. Another big area is the energy transition, arguably one of the greatest and most ambitious things the human race is going to take on, which is take the entire fuel system that powers cars and trains and airplanes and throw that onto the electric grid and try and do that with zero carbon footprint. That is a staggering investment, and it's investable. So there are interesting areas, but if these rates stay high, and they'll stay high if inflation stays high, it will result in having to look for different areas and being more creative than following a simple playbook.
I love being the bullish one.
I'm
I
amazed.
do that very often.
No, it's phenomenal. The chart. One of the things out of the chart earlier was that the top endowments have outperformed fairly handily, but there's a pretty big gap between the top and the median endowments, and so that's all about implementation and the managers you're picking. Endowment management has a received wisdom of active management, I'd call it. At the Daily Journal meeting the other day, Charlie Munger said, and I quote, "How many managers are going to beat the indexes? All costs considered, I would say maybe 5% consistently beat the averages." So endowment management is making a big bet against Charlie in that regard. Matt, you've worked at Goldman Sachs Asset Management, BlackRock, and now at TIF, three very different types of approach to active management, I'm sure. What would be your observation there as you construct client endowment portfolios today?
Well, I agree with Charlie's assessment broadly that there's a large portion of the investing public that shouldn't try. Just go into the broad indices and declare victory, and check it once a quarter, and that's it. I would say that if you look at a lot of the academic studies that say, oh well, gosh, there's no alpha to be had, the markets are perfectly efficient, all these sorts of things. I mean, they're often run on mutual funds that have very, very high fees, right? And one of the elements that we would argue for is if you look at the characteristics of managers, if you're focusing on managers that are highly aligned with their investors, managers that do not have a history of steeply growing their AUM, managers that have high active share and are taking a significant amount of risk relative to the benchmark, managers that have most of their fees come to them through performance fees as opposed to management fees. We would say that the data indicates that, look, those types of managers actually do go out and beat the benchmark. And firms like GEM and TIFF and others, we spend an enormous amount of resources going out and identifying the folks that have these characteristics, and we think can go out and beat benchmarks. And by and large, that has borne out. We've been able to do it. So I guess it's an agree and a disagree to Charlie's comment.
Right. So careful manager selection.
Yeah.
It's funny you say that what most people should do. I should mention the follow-up to David Swenson's pioneering portfolio management was basically titled, "Don't try this at home." Like, don't try to do this for your own investment.
Eric, you're involved in two organisations that take slightly different approaches than the broad body of endowment managers, I'd say. One with a weight to passive, an intentional weight to passive exposure, which is interesting, and another with a more direct approach, disintermediating managers. Any thoughts on those approaches and whether they may potentially more broadly adopted within the endowment community, or whether they indicate anything more broadly?
Yeah, I'd say it's still early in terms of how the model is moving. I think one of the drivers, the primary driver of the model, is to be at the top of this league chart. Because every extra dollar is a dollar for good. So in a foundation role, the more you can grant, that's the real important part, not the returns, but what you can do with the returns. So you are first driven to have these high returns, and in the endowment world, the university endowment, it is, as mentioned already, an all-out arms race, because whoever generates the most returns can endow the most professorships, and everyone wants to be full needs blind tuition and all of those, and the list of spending priorities is astronomical, plus what the research. The second big driver, to answer your question, is these portfolios have gotten very large. So when you look at some of these portfolios that are not performing, they tend to have 300 to 400 managers, because I would say it starts with board dysfunction and lack of clarity in terms of what are you trying to do with the portfolio. The team doesn't know, it's trying to preserve its job. And then secondly, if you have lots of turnover because of board dysfunction and lack of clarity, you're inheriting a portfolio that's been built by many other players, and you don't even know where to begin in cleaning out the garage, and you end up owning 300 managers, 4,000 securities. There's no way 4,000 securities going to beat 500. So in recognition of both performance and trying to answer the question, what do you do when you have a big portfolio so that you can make sure the people that are most talented are really having an impact on the returns, is to concentrate. So to answer your question, the new playbook, or an appendix or an addendum to the playbook, is to really cut your manager count down, deeply engage with the managers you know. So spend time, get to know them, know how they're wired, know how they make decisions. So when the inevitable tough time occurs, and it always occurs, you can say we're with the right people, they are thinking well, and we're with them all the way, maybe give them more. And then the second big thing that's happening for these bigger portfolios is to co-invest, to really be able to concentrate your best ideas with your best managers who are finding these companies, and to look for firms that where your balance sheet can partner with them. Because if you go to a venture firm and they invest in 15 companies and you put 1% with them, it is going to be really hard to have 1% position in your portfolio with the company that both your manager, who you very much respect, thinks is the best thing in their portfolio, and you see it as well. So this idea of co-investing in concentration and really trying to get those top holdings to be 10 or 20% of your portfolio is a real exercise, and that's where some of that work is going. And the last thing is that endowments now, in the old days when there was, when I was doing this, you often would look for the biggest firms and you'd look for the best brands. Today, when you look at these elite players, they're all trying to find managers people haven't heard before. And so they can get the capacity, get to know them, and be able to build with them and apply more over time. If you can have 3 funds and 4 or 5 co-invests, now you're starting to get a big share. But it's a multi-year effort to do that.
Yeah. Is it an accurate statement, though, to say that at least the top half of this list, which was up on the screen before, if it could go up again, that'd be great, have had their returns significantly boosted by very concentrated exposure to a handful of venture capital names and even companies coming out of those funds?
Yeah, I mean, short answer would be yes. I do think it has been extraordinary, the innovation, the pace of innovation, the pace of company formation, and what is to come. So even though venture has its moments where it gets frothy, even though too many people get on one side of the boat, when you really look at what's occurring, and again, being an old guy, when I was first doing this, it was hardware, software, telecom. Today, it's every industry, agriculture, building materials. It's the whole spectrum of innovation that's coming in, what's going on in healthcare. And so venture has huge potential return enhancement, and that innovation cycle tends to be pretty independent from all the other stuff when we're trying to figure out what should we pay for a building, what should we pay for a factory. The pace is very strong, but it did get quite pricey.
So how does that key into likely venture commitments from endowments and your clients over the next period of time? As NAVs probably haven't adjusted to the new reality of public market valuations, so they're likely to come down. Illiquidity is probably at a cyclical high among endowments. Can we expect commitments? Can we expect a retrenchment?
Budgets are going to be tight, and one thing seems different with this cycle to me is distributions were sort of very lumpy and concentrated. If you look at tech, sort of venture-backed tech IPOs, it took until 2021 to top the 2000 number, so the bubble number of actual realizations. And those are in nominal dollars, which is just absurd. And as I said, it was also pretty lumpy, so I think there got to be this kind of religion of company building and holding on longer. I blame Zuckerberg for that. So longer you stay private, the better. And what it's, I think, done through this cycle is it's sort of starved some of these LPs, frankly. There's been less of the capital to recycle than even there was. In the bubble, there was this thing that got created, you remember, it's called distribution management. They made a whole cottage industry out of having a manager that would sell your IPOs because there were too many to keep up with. Now, that is a high-class problem we didn't have this time. And so I think that the cash cycle's sort of been interrupted. We've cut but we do this annual budgeting exercise. We've cut our budget to venture. It doesn't mean we're out of the market. It doesn't mean we're not looking at new groups or what have you, but the commitment budget for this year is going to go down.
Mm-hmm. Yeah. Same at TIFF?
Similar, yeah. I mean, our instinct is that there's probably a little bit of retrenchment on the marks, and yeah, generally on the same page, we're likely to be cutting back a bit on the commitment side.
Well, great. I think we're near the end here. Anything you'd like to add that we missed? Feeling good? Thank you very much, everyone, for listening.